Banks spend billions convincing you that buying a house is the smartest financial move you'll ever make. What they don't mention is how much money they're making off that decision. We're talking hundreds of thousands of dollars extracted from a single mortgage, and the math behind it is so perfectly designed that most people never even notice what's happening. You've been told homeownership builds wealth. You've heard it's the American dream. But strip away the cultural messaging and look at the actual numbers, and you'll see something banks really don't want you thinking about too carefully. Let's start with the obvious revenue stream. When you take out a $300,000 mortgage at 4% interest over 30 years, you're not just paying back $300,000. You're paying back $515,610. That extra $215,610, pure profit for the bank. And that's at 4%, which is actually pretty low by historical standards. Bump that rate to 5%, and suddenly your total interest jumps to almost $280,000. Same house, same loan amount. The bank just made an extra $65,000 because rates went up 1 percentage point. But here's what makes this fascinating from a psychological standpoint. Most people shopping for a mortgage focus almost entirely on the monthly payment. Can I afford $2,500 a month? That's the question running through everyone's head. The total amount you'll pay over the life of the loan barely registers because it's too abstract, too far in the future to feel real. Banks understand this better than you do. They know you're not thinking about year 15 when you're still mostly paying interest. They know you're not calculating how much of that early payment actually reduces your principal balance. You're thinking about whether you can make this month's payment and next month's payment, and that narrow focus is exactly what makes 30-year mortgages so profitable. Because here's the part that should make you pause. In the early years of your mortgage, your payments are almost entirely interest. Your balance is highest right at the beginning, which means the bank is collecting maximum profit from day one. By the time you've made it through the first decade, you've handed over a massive chunk of money, but you've barely made a dent in what you actually owe. Even if you sell the house or refinance 10 years in, the bank has already collected the most profitable portion of your loan. They got their money up front when it mattered most to them. Now consider what happens when banks sell your mortgage. You're still making payments to someone, but the original bank already got paid. They sold your loan, often at a premium, pocketed immediate profit, freed up their capital, and moved on to originate another mortgage. During the pandemic, this process became so lucrative that mortgage lending profit margins hit 262% of the historic average. Not a typo. 262%. The system works because it's designed to work. Banks aren't hoping you'll buy a house. They're structuring every incentive, every marketing message, and every cultural narrative to make sure you do. And the beautiful part, from their perspective, is that you'll probably thank them for the opportunity. You'll sign documents you barely read, agree to terms you don't fully understand, and spend the next 3 decades paying back nearly double what you borrowed. But there's more happening beneath the surface that makes mortgages even more valuable to banks than just the interest payments. The revenue streams multiply in ways most borrowers never see coming. Let's talk about servicing fees, something most borrowers don't even know exists. When you make your monthly mortgage payment, someone has to process that transaction, manage your escrow account, handle customer service calls, and keep track of everything. Banks charge for this service. Even when they've sold your actual mortgage to another institution, they often keep the servicing rights. That means they're still collecting fees from you every single month, even though they no longer own your loan. It's passive income that keeps flowing year after year. Then there's the cross-selling opportunity. Once you're a mortgage customer, you're essentially a captive audience for every other financial product the bank offers. Need homeowners insurance? They've got a recommendation. Want a home equity line of credit for renovations? They'll set you up. Looking for wealth management services as your home appreciates? They're already preparing the pitch. One mortgage turns into multiple revenue streams, all stemming from that initial decision to buy a house. What makes mortgages particularly attractive to banks is the collateral. Unlike credit cards or personal loans where the bank takes on substantial risk, your mortgage is secured by the house itself. If you default, they foreclose and sell the property. They're almost guaranteed to recover their money. This security allows them to offer lower interest rates than unsecured debt while still maintaining healthy profit margins because the loan amounts are massive and the terms stretch across decades. The psychological game here runs deeper than most people realize. Banks have spent years studying borrower behavior, and they've discovered something crucial. Homebuyers fixate on monthly payments, not total costs. Show someone a 15-year mortgage with payments of $3,328 per month, then show them a 30-year mortgage at $2,552 per month, and most people immediately choose the 30-year option. Never mind that the 15-year mortgage saves them over $100,000 in interest. The monthly number is what registers. This focus on affordability rather than total cost is exactly what keeps the system profitable. Banks aren't forcing anyone to take 30-year mortgages. They're simply offering them, knowing full well that most borrowers will choose the option that feels manageable right now without calculating what it actually costs over time. You walk away thinking you got a good deal because you can afford the payments. The bank walks away knowing they just locked in decades of profit. Consider the broader ecosystem banks have created around homeownership, the cultural narrative that renting is throwing money away, the tax benefits they emphasize in their marketing, the stability argument that owning gives you predictable housing costs. All of these messages serve to funnel more people toward mortgages, which ultimately serve the bank's interests. They've positioned themselves as partners in your journey to achieving the American dream, when really they're the primary beneficiaries of that dream. Current mortgage rates hovering around 6 to 6.5% represent ideal conditions for lenders, high enough to generate substantial profit, low enough that qualified buyers can still access loans. The volume stays strong while margins remain healthy. Meanwhile, you're signing documents, shaking hands, and genuinely believing this is the path to building wealth. And maybe it is, eventually, if you stick with it for 3 decades and the market cooperates. But along the way, you'll pay the bank nearly double what you borrowed, and they'll call it a fair deal. That's the real genius of the system. Understanding how banks profit from mortgages doesn't mean homeownership is inherently bad. It means you should know exactly what you're signing up for. The next time a bank representative talks about helping you achieve your dreams, remember they're running a business, and that business depends on you taking the longest, most expensive loan structure available. The 30-year mortgage isn't designed for your benefit. It's designed to maximize their return while keeping your monthly payment just low enough that you'll say yes. Maybe that trade-off makes sense for your situation. Maybe it doesn't. But at least now you know who's really winning when you sign those papers. The house might eventually be yours, but the profit? That belonged to the bank from day one.